Hi, JJ here with the Out of Value. A burning question from a lot of investors lately is, are Chinese stocks uninvestable right now? Or alternatively, have they sunk so low that they're a very good and historic value investing opportunity? Well, for a start, Chinese stocks certainly have gone down a lot since really 2020, late 2020. If we look at the chart on screen here, if you're on YouTube or Spotify video, you'll be able to see the chart. I've got the Golden Dragon China Index here, which is down 73% since February 2021. Also, we've got the China Internet ETF, KWEB is the ticker, and it's down 77.7% since the 12th of February 2021. And of course, Alibaba, which is down 77.5%. My last video was about Alibaba more in depth. I'm a shareholder of Alibaba, so I looked at that and what's happening with Alibaba. I'll put the link in the description to that video, so go back and have a look at that if you want to after seeing this. As I said in my last video, the most recent move down from Alibaba was because President Xi got a third term, unexpected from many investors, and investors didn't like that because of some of the things that he said and the way that he's been acting for the last few years. If you're on video, you can see on screen the headline that says, "Frustrated and angry, global funds worry about Xi's new China." Some of the comments that he's made, some of the actions in recent times have led a lot of investors to believe that China might be moving more away from the market system to this question of being uninvestable. Lately, some analysts have been led to say that China is now uninvestable. On the screen, we've got a headline saying, US-listed Chinese stocks drop 15% after Beijing's power shuffle makes the market uninvestable. And in another article, stocks based in the world's second largest economy are uninvestable again, Bernstein sales trading desk's Mark Shilsky said in a note on Monday. So we have multiple investors, analysts saying that China is now uninvestable, perhaps because they bought earlier on and they've lost money and now they're selling out, so they're saying it's uninvestable for the time being. Are Chinese stocks really uninvestable, or is this actually a classic buying opportunity, a value buying opportunity for the long term? Let's find out. As you'll see on screen, China recently had its 20th Communist Party Congress, which I covered in my last video as well, where President Xi consolidated his power. He's there for a third term, and that kind of spooked investors. That was the recent route that we've seen. It's rare for a Chinese president to get a consecutive third term, which Xi has, and he's surrounded himself with people that agree with him, of course, so that's sort of spooked investors given what he's been doing lately with COVID lockdowns and some of the crackdowns on tech companies, etc. So we're in for more of that, investors think, and that sent the market down even further, even after the huge drawdowns that Chinese stocks have had in recent times. At the conference, the president spoke about continuing to pursue common prosperity, however you interpret that. So there's a headline that says, Xi Jinping's common prosperity policy makes a return. Common prosperity never really went away, but he's been speaking more about it. Investors are concerned that that might mean more harsh measures for companies in China and more regulation. So the comments might suggest that China is starting to move more away from the market system that they've been leaning into in recent decades, step by step moving away from it, which of course worries foreign investors in particular. There was even this article in the South China Morning Post which said China's Xi Jinping sends warning signal to the wealthy as he opens new front on common prosperity push. And a subheading that says, President Xi Jinping's report to the 20th Party Congress signaled more robust regulation to evenly distribute the spoils of China's rapid development. Analysts expect a wider array of taxes to support poor families and bolster the social safety net, while wealthy Chinese could face a rocky road ahead. So that's that last bit about wealthy Chinese facing a rocky road ahead, which of course could mean shareholders of the wealthy companies, the big tech companies. So that's concerned investors about the way this is heading. On the other hand, the value of many Chinese companies is very low. On screen, I've got a graph here, which is from Sven Carlin. I know I share some audience with him. Of course, he's got a much bigger channel, but thanks to Sven for this chart. He points out that the Hang Seng P ratio is currently 5.74, which is very low. It's never been that low. So in comparison to US companies, the US market is much more expensive. So by all accounts, the Chinese market is very cheap right now compared to historically and to the US market. So this chart's also from Sven. He points out that the current S&P 500 PE ratio is 20. So we've got, in China it's 5, in the US it's 20. And this is after the US market is in a bear market. It's gone down significantly from where it was. It was more expensive, but still comparatively to the Chinese market, it's still way more expensive. So that's something in favor if you think that way. And if you're thinking in value investing terms, the Chinese market is not expensive. So maybe it's an opportunity rather than uninvestable. This is another chart I like to keep track of. It's the current Shiller PE ratio for the US. It's currently sitting at 27.74. It did get high into the 30s, so it's come down, but that's historically very high. If you're watching on video, you'll see it going back a long time. So the median is 15.89. The mean is 16.99 historically. And the minimum it's got to is 4.78 in December 1920, and the maximum was 44 in 1999. And we all know where that was. That was during the tech bubble, just before the tech wreck. So 27 is historically high. If you're watching on YouTube and you are enjoying this episode, please consider giving us a like to help spread the video to more people. I'd really appreciate that. Thanks. This might be a good time to look at some other well-known Chinese stocks to see how much they actually have gone down. Looking at Pinduoduo here, PDD, which I am a shareholder of, it's down 68.45% from its peak. Didn't buy it at its peak, thankfully. This one's got a bit of a difference to it because if we look just in the last, since March 14th, which was the low back in March, it's actually up 142%. Still down a lot, but up 142% off the bottom, which is a little bit under the radar. We also have JD.com, which is down 58% from its high. We have Meituan, which is down 66% from its peak. We have NEO, a retail investor favorite from the EV sector. It's down 81% from its high. And from July 2020, it's down even from July 2020, so it's been wound back quite a lot. BIDU, which is down 75% from its high and continuing down. However, if we see the SSE composite index, the Shanghai index, we can see that it's only down 17%. So I'm not sure what that says to us. It seems like foreign investors are more concerned than people in China because there are a lot more domestic Chinese investors investing in this market. Of course, this isn't all about valuation. In fact, it's hardly about valuation. Everybody knows that the market in China is cheaper than in the US, and the stocks are cheaper. Equivalent stocks, if you think of Amazon, even though that's gone down a lot versus Alibaba, Alibaba seems to be a lot less expensive. But it's not about valuation. It's more about the macro, about politics, geopolitics in particular. There's also this assumption that in the US companies are free to do what they want with their cash flows. With the money coming in, they can reinvest it, they can give it back to investors, they can have buybacks in China with this new policy or seemingly new policy or changes in policy. Will that happen? Will there be regulations where perhaps money can't be returned back to shareholders, to investors? Maybe the government will claim more of it. There'll be high taxes, high regulation. So that's really the problem here with the valuation. A lot of people are concerned about those factors rather than the actual fundamentals of the companies themselves. So is China actually uninvestable? Again, Sven Karlin, our friend Sven's pointed out that whenever he's heard the word uninvestable, it's been a good signal to buy, and it's gone up 10x, as much as 10x since those words were uttered. And it reminds me, I heard Howard Marks say that recently about China. He said that he heard the word a few months ago about China and his ears pricked up. That's when his ears prick up, when he hears that word uninvestable, because that's often deep value territory, and historically things have often gone up when people have said that a lot from there. Some of the examples Sven pointed out is that in 2011 Europe was deemed uninvestable because nobody could see a future during the global financial crisis. Things looked pretty bad, and the stock market almost doubled from there if it was from the low. And the US banks during the global financial crisis, which looked really bad, there was a systemic issue. We all know what happened there. But if you had invested in the Bank of America in February 2009, it rose 831% till now, just at the very bottom. Not so if you'd invested at the top, but if you'd invested in the depths, in the very pessimistic times when people said it was uninvestable, it would have been an 830% return since then. I'll add to that with my own example. If you look at the NASDAQ index from the tech wreck, from the depths of the dot-com bubble back in 2002, say September 2002 until now. The market's up 757% since then. People thought that tech was uninvestable back then. It got to the point where it got so bad. I remember this one that people thought it's uninvestable. Don't invest in that. But in fact, if you invested in some of the good companies back then, we all know how they turned out. It turned out very well from the depths of the tech wreck. The classic example, of course, is Amazon. If you'd invested in Amazon in July 2000, which wasn't even that far past the start of the bursting of the bubble, it went on for a long time down to the Nasdaq bottomed in 2002. Amazon bottomed a bit before the index did. If you'd invested in Amazon back in July 2000, you would have made back 5,965% till now. And that's after the recent big Amazon drawdown. Of course, Amazon's gone up and down quite a few times, lost at least 50% multiple times. But even with the current drawdown, it's over 5,000% since then. So uninvestable back then, but look how it turned out. Let me also say about that, because I'm sure some of you are thinking it, there's some survivorship bias in there, because a lot of the dot-coms went away, went to zero, and perhaps that'll happen right now with some of, say, the ARK type investments, unprofitable tech. It seems similar to me, some of them, but for the good companies, I'm talking about the good quality companies like Amazon, who did very well over time. So of course, that's the hard thing in investing, is finding those companies, the quality good companies that are going to last even from the early stage. Amazon was quite at an early stage back then. There's absolutely no doubt though, there's a huge amount of doom and gloom about Chinese stocks in the Chinese market at the moment, which reminds me of John Templeton's saying. He said the time of maximum pessimism is the best time to buy, and the time of maximum optimism is the best time to sell. Of course, this isn't investment advice from me. This is just what John Templeton said, and there's no guarantees this isn't the time of maximum pessimism. It could get worse for various reasons. We can think of a number of reasons, but there's no doubt that there is a lot of pessimism, doom and gloom. It's all over the headlines through YouTube about how bad things are and that it's uninvestable. One other quote from John Templeton that I think is very relevant now too, and I've heard Howard Marks quote this as well. He said, bull markets are born on pessimism, grown on skepticism, mature on optimism, and die on euphoria. I think this relates to the US market and the Chinese market at the same time. So where are we in that cycle? Are we in pessimism? Are we in skepticism? Are we in optimism, or are we in euphoria? I think in the US there was euphoria around late 2020, early 2021 with those emerging tech stocks. But it seems no doubt that we're heading into pessimism in the US, and in China we're well into pessimism. Doom and gloom to the max. We don't know if it's maximum, but it could be. So I'd like to know what you think. If you're on YouTube, leave a comment and let me know, is China uninvestable? Does it depend on the company? What do you think? Or join me on Twitter and tell me there at The Art of Value. Some of the positives for the Chinese market is, of course, as Sven pointed out, that a lot of products are still made in China. So of US products, like over 90% of Apple products are still made in China. That's not going to change anytime soon, although they are starting to build products in India, and imports and exports to and from China and the US are back to pre-pandemic levels. So it's kind of business as usual, even with the COVID lockdowns that they're having in China. Things are geopolitically very difficult, but trade is still happening, and it's happening on a big scale, and the Chinese economy is still estimated to be the largest economy in the world in the not too distant future. Another positive, it could be said, as I also said in my last video about Alibaba, is super investors, some super investors who are still invested in China and in Alibaba in particular. If we look at Alibaba, we can see on the screen all those investors, as I said in the last video: Charlie Munger, Bill Miller, Guy Spear, Thomas Russo, and others, Prem Watsa, David Tepper, who has a new position, even in just in the last quarter. There's new 13F filings coming out soon. We'll be able to see the movements there, if they've bought any more, if they've been selling. But I mean, that's a positive sign in terms of some of the best investors in the world being still invested in China. And as I said, Howard Marks said he pricks up his ears when he hears the word Uninvestable. And of course, one of the OGs, Charlie Munger, is invested in Alibaba, and he thinks China has a good future. As you can see on the screen from Data Roma, he did reduce his position 50%, but that was thought to be for tax loss harvesting purposes. So he still holds a big position, and he still has had positive things to say about investing in China. He's been there. He's also invested in BIDU company through Berkshire Hathaway. So he thinks China is a good solid bet for the future. In fact, these are some of Charlie Munger's exact words about investing in China. He has said, when you buy Alibaba, you do get a sort of derivative. He's talking about the ADR there. But assuming there's a reasonable honor among civilized nations, that risk doesn't seem all that big to me. He's also said, and that's paraphrasing, that he's in China because the companies are stronger relative to their competition and priced lower. The businesses are better and the stocks are cheaper. And this was not extremely recently. It was this year, but earlier on, and they've dropped a lot since then. He's lost on the position, but I assume that he's going to hold for the long term because he's kind of the goat of that, of holding long term for a very long time, making the decision, swinging big and holding for a very long time. So we'll see what happens, but that's what he said about investing in China. And of course, he invests through Li Lu, who grew up in China. He's the only investor that Charlie Munger trusts to invest for him, and he knows a lot about China. So you can assume they've had a lot of discussion about it. Munger did also say that he wishes that the US and China got on better. It would make things a lot easier from an investing point of view. But then again, there might not be these big opportunities that come along that he swung big at the time that he bought Baba. To sum up, there are definitely risks investing in China. There are things that could go wrong if you invested in China, even at this point, even after it had gone down a lot. I haven't even talked about the Taiwan-China situation, the tension there. If that ramped up, who knows what would happen. Thinking about catalysts for how it could get better as opposed to worse, we've got the China-Taiwan tension, which could make things worse. But what could make things better is this has been announced just recently. China State Council reiterates policy support to bolster country's digital economy as tech war with US intensifies. So they actually want their tech companies to do well over time. So that's a positive. The other thing that is a positive is that China unveils a $44 billion in new support to bolster battered economy. So it's not great that the economy is going down, but they want to stimulate. So we've got the situation in China where the Fed in the US is actually raising interest rates and doing the kind of the opposite of what China's doing, because it's been so beaten down in China, and the property market in particular, that they're actually at the point of stimulating, which has, as we know in the past, helped the stock market. So that's another positive. So there are pros and cons. It seems at the moment, when it's very pessimistic, there are a lot of cons to investing in China. So it depends on your risk profile about what you think is going to happen in the future, if valuations go up, if things change, or if things actually get worse over the long term. Over the short term, there don't seem to be many catalysts. So over the next 6 to 12 months, it's actually hard to see how the news could get better, but we're talking long term here, and certainly Charlie Munger thinks very long term. So it depends on your risk profile about investing. Personally, I'm invested in Alibaba and PDD, and I'm not thinking of selling. I'm not thinking of buying either because I've reached my allocation. As I said in my last video, if you want to go and watch that, there's more on Alibaba in particular. I kind of like PD because it's positioning itself as the world's biggest grocer, and it's like food infrastructure for China, but delivery and connected to the internet, involving the internet, integral infrastructure for China and for the people. Will these stocks get better from the valuations they are and be multi-baggers from where they are? We just don't know that. But it will be interesting over the next 5 to 10 years. Over the short term, we just don't know. It doesn't look good. But over a longer term, it's going to be interesting to see how China in general works out and how the stocks in China work out as well. If you've enjoyed this episode, if you think you've got value out of it, please consider subscribing on YouTube if you're not already, or in your favorite podcast app if you're on audio. Subscribe or follow, whatever it allows you to do. And I'll see you next time. Thanks for watching.